on that 50% target. Put that order out there so that you don't have to monitor it, and then you'll see. Again, your P&L open percentage will convey whether or not you're at 50% or not.
Yep. And there's actually been times where I've woke up, but when the market opens at 9:30, I'll get an email that says I've been filled. And I'm not even on the Tastyworks platform. I'll just get an email. And I was telling Eric, I was at the dentist a couple weeks ago, and it's nice to be able to put those the positions on where it'll automatically fill and you're not constantly monitoring it.
Right. Yeah. Absolutely. And so now, right now, I'm actually at 88%. So if I go back into the activity tab and look at the what the market is willing to pay and what I'm willing to pay, obviously I'm willing to pay more. So now in a case like this where I'm actually looking at it, I'll go in and cancel the order, right? Well, I could have just actually, I'm sorry, I didn't really have to do that. I could have just basically did a reorder, but go in here now and just close it out for 63% versus the 50%. So as you can see now, where I was looking to pay 22 cents, now I'm willing to pay 16 cents, which is 6 cents less, but that means my my profit, if I get filled, will be slightly higher, right? Because as opposed to 50% right now, we're at 56.8%. But again, yeah, so in that case, I could have just went in here, did a right click, and as opposed to canceling the order, I could just just replace order, open the lock, right? Open the lock, and when you open the lock, it basically defaults to whatever the market is willing to pay to close this order. All right, so let's see if I get filled on this. All right. So still haven't gotten filled yet, but as you can see here, GME is a very liquid stock. That's the reason why it has four stars. And if you look at the volume over here, the volume is pretty significant. So we're talking about 55 million shares of GME that's been traded thus far, and so it's a very liquid stock. Liquid meaning that there are a lot of folks who are participating in this market, and so theoretically, it's easier to get filled and very liquid underlines. But as you can see here, it can be challenging with liquid underlines as well. So now I'm asking for 19 cents, and now they want 10 cents. So I'm actually willing to pay more, and so in theory, I should be able to get filled pretty easily, but it's not the case. It's constantly fluctuating. Okay. Yeah. Yeah. So so basically, which underlines have you primarily been trading? I know you keep track of your trades,
Apple's a favorite of mine. Recently, I've been trading Pinterest, Pins.
Okay.
I've traded Tesla since probably for the past 2 months. What are some other ones? Square is a good one. And a lot of these companies, Apple hasn't moved much, but when you put on these vertical put spreads or even naked puts, it doesn't matter if the stock moves or not, just as long as it doesn't, I guess, fall, which would make you become in the money. So if it stays the same, then you can still profit.
Right, exactly. And so that's the case here with our Beyond Meat position, where although my P&L is in the red, I'm down 26.4%. If I look at the actual trade itself, the position itself, the underlying is still well above, my vertical put credit spread. So I'm good. I'm good. And as time lapses, my theta value, I don't want to get into theta, but yeah, so So the time value will increase. That's your theta value, and so your theta value actually conveys how much money you're making per day as you get closer to the expiration date. And so you'll see this theta value, which is the reason why I told you guys, as when you go in to set up your platform, particularly looking at the column headings for your positions that I'm looking at here. It's nice to have that theta value column heading because you can actually see how much money you're making every day on your position. That's what theta basically is time, and we know that time is money. And so the more time you have, the smaller oftentimes you'll see this theta value, but as you get closer to the expiration date, this theta value begins to increase. And so the amount of money that you're making will increase as well. Okay. So Willeen, so you mentioned that your P&L is lower than mine on the GME position. Do you remember what the credit was you received for your when you got filled on the GME? So if I could take a look at it right quick. So if I look at activity, let me do GME. Oh, 78 cents. Okay, that's okay. 7 days. Okay, I got. Well, that's interesting. 44 cents. Huh. And so you have the same strike prices, 23 and 21. Oh, you at 30. Oh, that's why. Yeah, with 31 and 29. Okay. Yeah. So, okay. So let's just take a look at it here. Okay. So. So I am here, which is the trade I sent out, and so you're at 31. You said what was it? 31 and 29. Okay, so you're at 31 and 29. Okay, so the reason why my P&L is bigger than yours is because you are closer. Your position is the current price of GME than I am. So that also plays a role in your P&L as well. The proximity of your position to the current price of the underlying. So because I'm further away, that means that my position is less valuable than your position. And it sounds kind of counterintuitive, that my position is less valuable, but that's the whole objective of selling options. When you sell an option, you want to sell it for the highest credit that you can get, and over time you want the value in your position to decrease, so that then you can buy it back for less than the credit in which you receive for selling or putting on the initial position, right? And so, and also the further away the price of the underlying gets from your position, it also will help your position to lose value as well. And so you're closer to me. You're closer to the current price of the underlying than I am. So that's the reason why your P&L is not as big as mine. Make sense? Now, if you were, let's say, if you were here, right? If you were at 18 and 16, and I'm at 23 and 21, well, obviously I am closer to the price of the underlying than you would be, and so your P&L at this point would be bigger than mine, would be larger than my P&L. Does that make sense? No? Okay. Well, I mean, just look at it this way. The further away the price of the underlying moves away from your position the more position will lose. Right. So as you remember the position you talked about, I guess last week, a UVXY position, you're like right next to the current price of the underlying UVXY. Right. And so as a result, your P&L is going to constantly be negative because why? Because at any moment, the price could drop a few dollars and your position could be in the money. Well, if we look at the GME position, right? Clear. So you're here, right? So if the underlying drops, if it starts to drop, right? Let's say it gets down to 38. Right now it's at 58.37. If it gets down to 38, whose position is more likely to go in the money first? Yours or mine? Somebody just made money. Exactly, right. So yours, right? And so that, right. Oh, that's you making money. Yeah, so your position will go in the money first. And so that's the reason why position is, dangerous than my position, right? Because it's closer to the price of the underlyings. That's the reason why your P&L is not as high as mine, because your position has more value than my position has, because my position is further away. Yeah, so I mean that's the best way, that's the best explanation I can give right now that I can think of. I mean, it's all about proximity. It's all about the closeness, and so yeah, so that's the reason why, again, your 31.29 vertical put spread is not as profitable right now as my position, because my position is further away. And if the price drop, guess what? Your position will go. Your position will be in danger sooner than my position.
Okay.
Okay. All right. Yeah, and Alicia just achieved another great milestone, where basically at this point she has doubled her account. Is that right?
That is correct. I started in the summertime with my account of $10,000, and earlier this week I had achieved where I profited $10,000.
Right. So I mean that's that's less than a year. You know what I'm saying? That's less than a year. So is that your daughter?
No, that was me.
Oh, that's Wale. Oh, okay. Oh, Wale. Okay. Yeah, it's good. Yeah, because Alicia has two daughters. I thought that was her daughter in the background. Okay, yeah. Yeah. But no, yeah. So I mean, good stuff. So yeah. So this stuff works. I mean, it takes some time. It takes some time. But sometimes folks just catch on rather quickly. I'm getting questions here. Congrats. Oh, cool. Okay. Congratulations. Yeah. So yeah, so that's where we are. And again, I keep, trying to, convince and encourage folks who are in my inner circle that, it's really a waste of time to have any large amount of money in the bank at this particular point, because with the monetary policy that has been implemented by the Fed, I mean, the interest rates are practically zero. So you're basically giving the bank at this point, a free loan, and they are lending your money out at they're giving you 0.05% or less every year, and they're lending your money out and charging anywhere between 3 to maybe 7 to 8%, depending on the credit score of the person who's borrowing the money. You know, so they call it net interest margin. And so they're basically, making an enormous amount of money off of your money while your money is sitting in the bank dormant. You know, it's dead money. You know, and so, although trading is risky, with the credit spreads, you can cap your risk. You can determine, your maximum potential loss. And if you just, follow, the instructions and not really try to take on too much risk by getting too close to the price of the underlying, you can make 20 to 25% on the capital that you are risking for any particular position, in a month or so or less. We have seen that thus far with the two positions or the two trades that I sent out. I mean, we were able to close those within a matter of a week or so, and so there's a great way.